Everybody, and welcome to our webinar. I'm very pleased to see so many people attending this morning. We've got a slightly different approach in that we're going to be spending probably half an hour to 45 minutes having a broad discussion on the issues of share scheme design that we see both from our sort of extended experience and also from some recent discussions we've been having with clients in the context of the current environment, both commercially and in tax terms. So I'm joined this morning by Charlotte Fleck. My name's Stephen Woodhouse, so it should be about half an hour, 45 minutes, and I hope you find it interesting. So one of the points that I would make whenever I have a client coming in to talk about setting up a new share scheme or a new incentive plan of any sort is to start with the question, what are you trying to achieve? So what is the share scheme trying to achieve? Is it right that it should be a share scheme? Think about the commercial objectives. The typical goals that are set are retain and incentivise employees and align interests with shareholders. Perfectly valid, correct considerations to have. I think there's a danger, though, when looking at the design of share schemes, of thinking about what is required in stereotypical terms. I think it's important to have whatever scheme is designed to reflect the real, specific, concrete objectives of the organisation. And time and again I've seen share schemes set up where that has not been followed through, and the consequences vary, but will typically result in a share plan being introduced, which results in shareholder value being given away, but not actually achieving any real objective. And that can be, over time, can be quite negative in terms of the impact on the individuals, the impact on the shareholders who regret having given that value away, and can result in the share plan having the opposite of the intended effect, in that it can create friction between shareholders and the participants and can actually be corrosive of value rather than adding to value. So the first key point really is that it's critical when looking at setting up a new share scheme to be thinking hard about what the organisation wants to achieve, what sort of time scale, link that into the shareholders. Linked in with that, I think, is proper communication, because if there isn't the clarity on the objective, then all of these objectives cannot be achieved. You can't work out what you're trying to achieve unless you've spoken to all of the relevant stakeholders. And I think the other side of that coin is that if the shareholders spend a lot of time thinking about their share scheme design and they do not discuss those with the participants before the plan is set up, so that the participants are just given a fait accompli, well, the shareholders may think that they're happy and they've got the objective sorted out, but if the participants are not buying into it, then it still won't achieve the objective. What goes from that as well is that everything else follows from these commercial goals. So looking at it from the point of view of the shareholder, what is it that the shareholders want the employees to achieve? Remember the obvious point that employee management performance tends to be driven, because that is the object of the exercise, by the output of the plans which are put in place. And therefore, if you put in place a plan which rewards behaviour which is not what the shareholders want, it is entirely likely that that is the behaviour that will be achieved. And that point is illustrated by much of the debate seen over the recent years with listed companies, where there have been quite stringent, specific financial performance goals put into share plans at the behest of the shareholder groups, the institutions. And what has then resulted in many cases is that management have focused on those specific objectives. They've hit the objectives, but they've achieved that at a wider cost to the shareholder base. So to take a specific example of that, we've seen examples where major companies have followed through a share buyback program, and when challenged as to why the share buyback program was thought to be appropriate, The true analysis was that it helped the management to meet their KPIs, key performance indicators set out under their equity incentives, and increase the value to management of those incentives. It wasn't in the interest of the shareholders. And I think that's just one example of the sort of effect that can be produced if the commercial goals are not properly thought through and aligned with the content of the share scheme. So what is the plan trying to get employees to achieve? What does success look like? I mean, I think it's worth having a thought exercise when putting together a share plan and saying, well, if we hit all of these goals, what will the company look like? And is that what we want the company to look like? And if the answer is no, then you need to start again. I think that it's important then to think ahead as part of that exercise and say, well, if these targets are met, what are employees going to receive? And that can flow through in many different ways. I think that it's important to ask for shareholders to ask themselves, particularly when you're looking at a private company when there's substantial growth potential in many cases, if we achieve, what do we aspire to achieve over the period of the share plan? And if we aspire to have a start-up and getting to a target of a value of, let's say, 100 million, and an award is being made today to somebody in respect of 10% of the share capital of the company, are you happy for that individual to walk away with £10 million if that target is met? Now the answer may be yes, and that's fine. But if the answer is no, then the parameters under the share scheme aren't what they should be. So think about what happens, what actually value is delivered to people if the targets are met. Also think about the implications at that point, and think about what the position is if the targets are not met. So if you've got a performance indicator requiring the company value to get to 10 million, if the value gets to 9,900,000, does that mean there's going to be no vesting? Does that mean the individual walks away with nothing? Or does it mean that he walks away with 9.9 million? 10% of 9.9 million. And in terms of the work that we do in designing the detail of the scheme, broadly speaking, we can deliver the result that you want to be delivered, provided that it's clear what it is that you want to be delivered in those circumstances. So you could have partial vesting, you could have a deferral of vesting. There's all sorts of ways in which differing objectives can be met, but only if they're identified when the plan is being designed and when, as a result of that, the documentation is being prepared to reflect that. I think that in addition to just thinking about what the employees will be receiving, there's a key question of when can the employees realise their interests. And what I'm really getting at here is that the commercial thinking, it needs to be looking at it needs to be holistic thinking. It's looking at the overall picture. So I would generally expect and would generally recommend that share plans are focused on a number of key people, particularly with smaller companies starting up. Having a plan which goes throughout the whole company may be the right thing for any particular company, but in many cases it will result in equity being distributed in a manner which does not optimise overall value. So typically the awards would be going to the key people in the business. And I think a point there to think about is, well, if you've got, let's say, a CEO of the business, he's driving the business forward, he's got a 5-year plan, he's got a 5-year plan to deliver, let's say, 100 million of value, and at the end of that period he's going to get, again, the purely notional example, 10% of the value. Everybody is happy, except there's a problem, which is that what is the exit going to be? Is it going to be a sale to a third party? Is it going to be a listing? What happens if the shareholder doesn't want an exit at that point? Does the individual still have the ability to realise the 10 million of value? And if so, where is the 10 million going to come from? If that individual is the CEO and he's viewed as critical to the business going forward, if he realises £10 million, that is a very obvious time for him to take stock, step back and think about something else to do. It might be work for a different business, it might be to go and sit on the beach for a while. the point is that the very person who is critical to the business may in fact be incentivised to leave at the critical time when you want to realise the value that is being incentivised to produce. So think about that up front. Do you want to have provisions which require an individual to hold on to shares for a period of time? There's some merit, arguably, in trying to use share plans to build up long-term lifetime wealth. So a bit like a quasi-pension plan in the way that has been seen over many years in the US. There are arguments against that as well. But the key point is to think through all the consequences at the top, at a high level, of what is a very significant step being taken in the allocation of the value of the company. Now, a particular area there in terms of thinking is the question of growth shares. And many of you will be familiar with this, but I will just explain the concept in case there are people on the call who aren't, because I think that the use of growth interest is likely, in my view, to become more prevalent. We'll talk about this more as we go through the discussion, but I just wanted to introduce the concept. What are growth interests? Well, growth interests are a form of equity interest. I mean, there are different forms, we'll come on to talk about them, which allow employees to participate in the growth in the share value to which they contribute. So in many ways you could say that an option is a growth interest, but what we generally mean when we talk about a growth interest is acquiring a share or an interest in a share up front, so that the individual becomes an immediate shareholder, either individually holding shares as a beneficial owner or under a joint ownership structure, but where the share interest is only in respect of the future growth and value of the company. And that we found is an important tool to have, partly because it delivers potentially beneficial tax results, partly because of the commercial impact. What I will do, if I may, is just ask Charlotte to expand on that and explain that a bit further.
Right. I'm going to start by talking a bit about the different varieties of employee share plans that are available. Again, the same point Stephen made. You want to think about what you're trying to achieve with the plan, and start from there rather than thinking about what might have the most beneficial tax results. So, at a very simple level, you can set up what's called a phantom share plan. You undertake to pay your employees a cash bonus based on the value of your shares. That has a lot of advantages in terms of being very simple and straightforward to administer, and maybe that is what's right for you. Moving on, share options grant your employees a right to acquire shares in the company at a future point. Usually the employees will have to pay the market value of the share at the time the option was granted, the idea being that the shares will increase in value, so when they exercise the option they'll achieve a gain. If the share option plan is right for you, maybe it's also right to look at whether you qualify for one of the statutory plans which allow you to grant share options on tax-favoured terms, such as EMI, or for an all-employee share plan, SAYE, maybe even CSOP, though we see fewer of those these days. Again, these are all sort of options to investigate. Then you may also think you want to give your employee a direct share award. Immediately award them shares based on terms maybe that they have to forfeit them if targets aren't achieved or if they leave. You might want to say your employees, okay, we'll let you buy shares. That does have the advantage as well, or possibly the downside of your employees will also be exposed to any risk that the shares drop in value. And again, a lot of employers may think that giving your employees what's often referred to as skin in the game in that way is actually advantageous. I'm now going to come on to growth interests, as Stephen was mentioning earlier. That can be either, in slightly more detail, growth shares or joint ownership. Joint ownership, you award your employee a contractual beneficial interest in the share on differential terms with a co-owner, maybe a parent company, maybe a third party such as a trust, and on terms that the employee will have a right to, in the future, benefit from a growth in value of that share. Often for listed companies that's advantageous because it doesn't require you to create a new share class. Unlike what are referred to as growth shares, under which a private company usually creates a new class of shares in its articles, often with limited voting rights, but which allow the employees a very limited participation in the current value of the company, but a much greater participation going forward in the growth in value of the company, often subject to various hurdles and thresholds being met. Clearly, what circumstances are those actually going to be most useful for? Well, if the company doesn't have much existing value, for example, if it's a startup, you might not be too worried about creating special terms for new share classes, if in fact your shares realistically don't have much value right now either. You might just say, okay, we'll award our employees ordinary shares on terms that if they leave the business they have to forfeit them, and then they'll still be able to benefit if, say, in 5 or 10 years' time, as is often the hope with startups, there's been significant growth in value. Whereas for a more mature company with existing value, maybe it's not really beneficial to grant your employees upfront direct share ownership in ordinary shares. This is one of a few circumstances in which the tax consequences are worth considering, in that if you've got an unquoted company with valuable shares and you award your employees shares in that company, they will be subject to income tax on the full value of those shares. They won't be able to sell the shares to fund that tax. They may not in fact be able to sell the shares for quite some time until the point that there's an exit, a trade sale or a listing or some other form of realisation event. So your employees are effectively paying for something, at least in terms of paying income tax on it, that they have no immediate opportunity to turn into cash, and that may not be a very effective incentive. So this is where growth interests come in. You create an interest with limited value at the time it's awarded. If the company doesn't grow in value, that interest will never really be realisable. It will continue to have very limited value. But if the company grows in value and if the targets are met, then that growth share can become significantly valued to the employee. And that's clearly a desirable situation. You want your employees to have an incentive to grow the share value. So how do growth shares work? As I've said, you're going to need to amend the articles of the company. You create a special class of shares. You have to think quite hard about share rights to begin with and start with the design and what you're trying to achieve, then move on to the legal drafting and valuation. And it's quite important to bring all this together at an early stage. You might think, okay, we're going to put together all these careful targets for what we want the employees to get in the future, and then do a valuation exercise and find that actually that may not work out quite as you'd expected. You might, for example, find that the shares have a lot more initial value than you're expecting, and that creates again the problem that employees can be paying fairly significant amounts of tax on something that has no immediate value to them. Again, that can be a disincentive. So it's important to work through the valuation points, etc., at an early stage, rather than realising much later on that the fairly complicated share rights you've come up with don't actually work and need to be revised at a considerable cost and time expense quite often. I will say here, just anecdotally, if you decide for your growth shares that you would like, for example, a complicated target structure with, for example, as a real example, different targets over 7 years, target changes each year, the amount that the growth shares pay out changes each year based on changing targets. Maybe think about the degree of complexity you're creating versus the benefit to shareholders and to employees. In terms of how effective it is as an incentive. Excessive complexity can actually be counterproductive in terms of, do your employees really understand what they're getting and what they need to achieve? And in terms of, is this proportionate to the value the company and shareholders are getting out of it? You also want to think quite at an early stage about maybe just do some preliminary valuation exercises rather than jump into a full stage valuation report later on when the terms are much firmer, just to get an idea of how things are likely to work out. That's what we often refer to as stress testing. Stephen, do you have any comments on that?
Yeah, no, I do. I think before I talk about that, I just want to pick up on an important point which Charlotte mentioned there about the complexity. I think that one of the big flaws with share plans is that they become overly complex, and the consequences of that are first that they become quite difficult to design. That results in complexity, and it takes longer and it's more expensive. The second point is that the more complex anything is, the more likely it is to go wrong, and that may sound like a fairly crude statement, but there are numerous occasions that we've seen in practice where the complexity of the plan, when it has come to fruition or it's come to a point where the impact is considered, it doesn't actually achieve what people wanted to achieve, because the excessive complexity means that the fundamental objectives have got lost. And one of those is that you are aiming, when setting a plan, to incentivise employee behaviour. And even at a senior level, if people don't understand the plans that they have, they're not going to be incentivised by them. And I've come across cases where I've had clients who've had substantial share awards which are either vesting, or in one case in particular somebody resigned from their position a week before he had £1 million of value which was due to accrue under his plan, and the point was he didn't understand that he had £1 million of value, and that meant that the company had not derived the value from that incentive which had been given. So I think that is a really significant point to have in the forefront of the thinking when putting the plans together. And I think the stress testing point is also an important practical point. It comes back to some extent to the overall issue I was discussing at the beginning of the presentation, which is just when you're putting a plan together, put some worked examples through. What happens if profits go up X and the multiple goes up Y? What does that do to the value of the company? What does it do to the value of the awards under the plan? What happens if the company performs badly but market multiples go up? Does that mean that the individual concerned will be walking away with the value anyway? And if he does, do the shareholders take the view, well, that's fine because we're getting value, or do they take the view that the individual should not get the value because the return's got nothing to do with him? And the converse is the same. If the company performs well but market conditions are poor, to what extent does the individual suffer the consequences of that in line with the shareholders, and to what extent is he protected? And the best way to do that is, as we've talked about here, stress testing. Just put some numbers together, build some models, put some what-if scenarios in, see what happens in different scenarios, and try to anticipate the likely outcomes. I'm not suggesting that you'll be able to get every scenario right, and many of you will be sitting there thinking, well, the one scenario we won't go will be the one that actually happens, and that may be true, but the more testing, sort of verification of likely outcomes there are, the less likely it is that the plan achieves something which is the complete opposite of what's originally intended.
I'll just come back in here to talk about some of the recent changes we've seen, particularly in the Finance Bill 2016, and what impact that might have. Firstly, reduction of capital gains tax rate to 20%. This is clearly further increasing the disparity in tax treatment between income and capital. That's going to be important for employee share plans in terms of, firstly, it creates a greater incentive to use growth interests because the tax treatment is more beneficial. It also means generally, I have had in a recent meeting, I had a client come to me and say, well, all our EIS investors can invest on very beneficial terms. Why can't our employees do the same? Why are they being treated more negatively than external investors? And I think that's a question that is increasingly likely to get asked, particularly in terms of under the coalition government, there was a goal to increase and broaden employee share ownership. I wouldn't say that's been altogether dropped under the current government, but it's certainly something we haven't seen very much emphasis on. It'll be interesting to see how that works out. Introduction of a lifetime cap on capital gains tax relief for employee shareholder share awards. If you're not familiar with those, employee shareholder shares were introduced in 2013 as a means of, in George Osborne's view, creating a more flexible labour force for smaller start-up companies. Employees would give up some of their employment rights, the big ones being the right to make claims in an employment tribunal for unfair dismissal and for redundancy pay. And in exchange for that, they would get shares in their employer or their employer's parent company. Income tax, all completely tax-free up to an initial value of £2,000. If they received shares with an initial value greater than that, up to £50,000, they were completely free of capital gains tax going forward. That capital gains tax has now been capped. So if your shares increase up to £100,000 worth of value over your lifetime, that's a lifetime cap, £100,000 worth of gains on employee shareholder shares, you can still get the capital gains tax relief. Any more than that, you're going to be subject to capital gains tax at now 20%. It's fairly clear to most advisors why that's been brought in. This is a relief that was originally intended for creating a flexible labour force for small companies. I'm not actually aware of any small companies that have used it in that way. There may be some, I just haven't come across them. What we mostly found it used for was to grant senior executives growth interests with an initial value below £50,000 in the hope that that would result in significant gains. And clearly some companies have already effectively banked multi-million-pound tax-free gains as a result of that. That's not really what the relief was intended to achieve, so it's not surprising that it's been capped. Came as a bit of a surprise. We did have some clients who were in a rather unfortunate situation of the relief was capped for employee awards entered into pursuant to an employee shareholder agreement entered into before midnight on the 16th of March. There is a 7-day waiting period between employees receiving independent advice and being able to enter into an employee shareholder agreement under the legislation. We had some clients whose the waiting period was over on the 17th of March. So that was rather unfortunate for them. I say that it was clearly quite a difficult situation to deal with. Going to skim over a couple of more technical changes now. Entrepreneurs Relief. Entrepreneurs Relief now available for the individual investors who subscribe for new shares in a company and hold them for at least 3 years, intended to encourage long-term share ownership by investors. There is a point there about will there be an increasing incentive for people associated with companies who might not otherwise have been, for example, non-executive directors, to operate through a personal service company instead, and acquire shares in a company in the hope that they'll get entrepreneurs relief under these provisions. In my view, that isn't what the relief would be intended for, so I wouldn't advise clients to take that approach, but it'll be interesting to see how that works out. Entrepreneurs Relief was tightened up a while back. Particularly, there used to be a structure involving where it wasn't practical to give all your managers 5% of voting rights and 5% of nominal value in a company to allow them to qualify for the 10% Entrepreneurs Relief rate of capital gains tax. There was a structure involving setting up a management company and having it invest in the actual company as a joint venture, despite the fact that none of those managers would have actually held 5% of the shares in that company on a flow-through basis. The amendment designed to prevent that did also catch some much more legitimate commercial structures. That's now been amended with the intention that normal commercial structures where if the person owning shares in a parent company would still have owned 5% of the joint venture company on a flow-through basis, Entrepreneurs Relief will still be available to them on a disposal. Also, an increase in the loans to participate is charged to 32.5%. That's where you make a loan to a 5% participator in a company by a close company, so one controlled by 5 or fewer participants. If that loan is not repaid by 9 months from the end of the company's accounting period, there is a tax charge to HMRC, and it is refundable when the loan is, or if and when the loan is repaid. But that has, for example, caused difficulties in terms of it's not realistic for a closed company to provide an employee benefit trust with loan funding. That's now increased. That's a fairly technical change, but worth being aware of. A change that might seem fairly technical but might have a much more extensive impact is that HMRC will no longer agree share valuations under the post-transaction valuation check or PAYE health check procedures. As a reminder of what that involves, if companies make share awards subject to PAYE, so that will be listed companies or share awards in a subsidiary for the most part, the company has to operate PAYE on its best estimate of the value of the shares. What if you get that best estimate wrong? You potentially have failed to operate PAYE correctly. That's not a desirable situation from anyone's perspective, including HMRC's. So previously they had a PAYE health check procedure under which you could submit a valuation to HMRC and ask them to agree that you had operated PAYE on a reasonable best estimate of the share value. That wasn't conclusive in terms of HMRC could then go back if and when the employees put in self-assessment returns and say, well, that might have been the best estimate at the time, so it was reasonable to operate PAYE on it, but we don't think that was the actual value of the shares. It might be that, for example, you might not have finalised the accounts for that period, etc. There are a number of perfectly reasonable reasons that, the share value an estimate of the share value at that time might be subsequently found, maybe it's higher or lower. So it was possible to undertake a post-transaction valuation check with HMRC to get final confirmation of the value of those shares for income tax purposes. That was taken away quite suddenly on the 31st of March. Very little time for no consultation, very little time for discussion proposed by HMRC. The consequences of that are still remaining to be seen, but clearly for the companies that are making share awards, there's much less certainty for both them and employees. I'm going to ask Stephen now to talk a bit more about the impact of the changes I've discussed.
Thank you, Charlotte. I think before I talk about the impact, I would just throw in an observation in relation to the changes to the ESS employee shareholder status rules and the restrictions of the reliefs, because I think it illustrates the dangers in an indirect way of not thinking through the consequences of share plans. There was a question asked in Parliament last week by one of the Labour MPs, Chris Leslie, to David Gauke, the Treasury Minister, as to what was the estimate that the government had for the cost of the ESS tax relief. And the answer given, it's a public answer, was in my view a classic case of politicians managing to sidestep the question, because what he did was to refer back to the estimate of the cost of the tax relief for 2015-16, which was given at the time when the ESS rules were introduced. But the interesting point is that the estimate at that time of the cost of the tax relief was £45 million. And what we've seen, and this is the reason I have no doubt why the 100,000 limit has been introduced, is plans which have offered substantial gains for senior management, and it is just not conceivable that 45 million is anywhere near the estimate or a proper estimate of what the value of the relief is going to be. We have had one example already where we've seen a company which has been considering realising value, where the executives had the potential to realise 20 million of value, which would have been entirely tax-free as a result of ESS. And the point I'm making there is that what that shows is that the ability for substantial gains to flow from share plans and not be understood and appreciated at the time when they're introduced is kind of writ large in the way that the ESS rules have been introduced, and shows the substantial potential that you have there for value, which therefore needs to be thought through very carefully up front. I think what also comes through is that growth interests remain a useful incentive, and they become more effective in tax terms. And by that, clearly at one level that's not a correct statement because the ESS relief is being restricted, but the point I'm driving at is that in the most recent budget we've seen capital gains tax rates reduced to 20%, while the income tax rates remain at 45% for top rate taxpayers, and with NIC charges on top. So you've got an effective marginal rate of personal tax in excess of 50%. Whereas for capital gains tax, the effective rate is 20%. And therefore, my expectation is to continue to see growth interest being used, and being used quite extensively. And we saw a publication come out from it was issued by HMRC, but it wasn't HMRC who actually wrote the report on growth shares, which effectively endorsed their use. I say effectively, it was an objective academic study, but there was quite explicit recognition that the authors of the report viewed growth shares as being used appropriately in the context of the current tax system. Having said that, as Charlotte mentioned, there is now no way to agree a valuation for growth interest for a straightforward issue of growth shares outside the employee shareholder awards, and this is going to have over time a substantial impact on the position of companies and participants in the plans. It means that shares will be issued, the receipt of those shares will need to be notified on individual self-assessment returns. The self-assessment number will then not be submitted to the revenue until the normal time for the completion and submission of the self-assessment returns, depending how efficient the individuals are, somewhere between 31st October and 31st January in the year. There will then be some degree of randomness as to whether or not any particular return is reviewed or not, and I use the word randomness deliberately because of the way the system for self-assessment reviews works. Many people will just find that their valuation is just ticked through without any issue. Other people will find that their valuation is reviewed, challenged. They can be subject to rigorous review by HMRC. There's a significant risk that there'll be some individuals receiving shares will be treated differently from other individuals, and a significant risk that there'll be differential treatment from one year to the next according to the attitude and approach of HMRC. All of these points are being raised with HMRC. We are organising a webinar for later in the year in September. The date hasn't been finalised yet, where we hope to, and we don't hope to, we will have the head of the Share and Assets Valuation Division joining us to discuss the new regime and to address some of these points. What I expect to find is that the change to the rules will not discourage the use of growth shares and other forms of share plans. What it will do, I think, is to place increased emphasis on the need for a rigorous valuation exercise to be conducted before the shares are issued, so that the company can justify using the value which derives from that valuation report for the purposes of operating PAYE, where PAYE is relevant. The obligation is for the company to use the best estimate of the value, and also to be there to provide contemporaneous evidence to support the valuation which is used for individuals when they complete their tax returns, with a view to achieving consistency and minimising the work required. So my expectation is that we as advisors, together with companies, and hopefully, to be fair, together with HMRC, will work out a way of ensuring that the tax system can work effectively and the valuation system can work effectively, notwithstanding the withdrawal of the PTVCs, and as a result of the development of the tax regime in terms of the reduction in the capital gains tax rate, the use of growth interest will continue to be of importance and will probably grow in importance. So with that thought, I will leave you to think over what we've been saying. Thank you very much for attending. We will now have a break in our webinar programme until September, when we'll be having the webinar I mentioned with HMRC. I think that should be a very interesting session, so I hope that you will join us for that. If you have any questions or comments in the meantime, do please contact us. The details should be on the screen in front of you now. Otherwise, there's nothing more for me to do other than to thank you again for attending and hope you have a good rest of the day. Thank you very much.
Thanks.